You wake up, you check your phone. Nothing strange happened overnight. No alarms, no headlines screaming new money created. And yet, somewhere between midnight and your morning coffee, millions of dollars quietly came into existence. No printing presses, no gold, no dramatic announcement, just numbers appearing. Silently, legally, automatically. This is the quiet machine that creates money while most people never notice. And once you see it, you cannot unsee it. Here's the uncomfortable truth most of us grow up with. We're taught that money comes from work, from productivity, from saving, from discipline. That story feels fair, comforting, almost moral. But the real system runs on a very different rule. Money is not primarily created by governments. It's not created by central banks either. Most money is created by debt, and the machine that does it runs every single day. To understand why this matters right now, look around. Prices feel permanently higher. Debt feels unavoidable. Asset prices move faster than wages, and no one can quite explain why. It feels like the game changed without telling the players. Because it did. Let's start simple. Imagine you walk into a bank and apply for a loan. A car loan, a mortgage, a business loan. Most people believe the bank checks its vault, counts its money, and then lends you what it already has. That's not what happens. When the bank approves your loan, it does something far stranger. It creates new money, out of nothing, with a few keystrokes. Here's the step most people never see. The bank does not hand you existing money. It credits your account with a deposit that did not exist before. That deposit is new money. The loan is the source. The money is the byproduct. Debt first, money second, always in that order. This is not a conspiracy. It's written into the system. In modern economies, over 90% of money exists only as bank deposits. Digital entries, promises backed by trust. When banks lend, the money supply expands. When loans are paid back, money disappears. The machine breathes in and out. Now pause and think about what that means. If money is created through lending, then money creation depends on willingness to borrow, not productivity, not innovation, not even savings. Borrowing. This is why growth, debt, and money are permanently entangled. Here's where it gets uncomfortable. Because borrowing is not evenly distributed. Those who already own assets can borrow more easily, at lower rates, with better terms. They gain access to newly created money first. That matters. When new money enters the system, it doesn't raise all prices at once. It flows into assets, into markets, into balance sheets, stocks, real estate, financial instruments. Prices rise where the money lands first. Wages, they come later, if they come at all. This is why asset owners feel richer while workers feel squeezed. Same system, different position. Now let's talk about the other machine people think creates money. The central bank, the Federal Reserve. Here's the twist. The Fed does not directly create most of the money you use. What it does is set the conditions. Interest rates, liquidity, confidence. It controls how easy it is for banks to lend. Think of it like a thermostat, not a factory. When rates are low, borrowing feels painless. Loans look affordable. Risk looks manageable. So banks lend. Money expands. Asset prices climb. When rates rise, borrowing slows. Loans shrink. Money tightens. The machine doesn't stop. It just changes speed. This is why rate changes feel so powerful. They don't just affect borrowing costs. They affect money creation itself. Slow the machine and the economy feels heavy. Speed it up and everything overheats. There's no neutral setting. Now here's the part no one likes to say out loud. This system requires constant motion. All debt is paid with new money. New money requires new debt. Growth becomes necessary, not optional. If borrowing slows too much, the machine starves. That's when crises appear. Look back at history. Every major financial crisis follows the same pattern. Rapid credit expansion, rising asset prices, confidence everywhere. Then something cracks. Borrowers hesitate. Lenders pull back. The machine stalls. And suddenly, money disappears faster than it was created. That's why governments and central banks intervene. Not because they love bailouts. Not because they enjoy stimulus. but because stopping the machine entirely is catastrophic. No lending means no new money. No new money means collapsing prices. Collapsing prices mean defaults. Defaults threaten the system itself. So the machine is protected. Quietly. Relentlessly. Even when it creates inequality. Even when it distorts incentives. Even when it feels unfair. Because the alternative is wise. This is the irony. The system that feels stable depends on constant instability management. The system that promises discipline relies on endless expansion. The system that teaches saving survives on borrowing. None of this is obvious from the outside. That's why most people never notice. So what does this mean for you? It means money is not scarce in the way you were taught. It means debt is not an accident. It means inflation is not random. It also means understanding the machine gives you clarity. Why asset prices behave strangely. Why wages lack. Why policy decisions feel delayed. Why normal never returns. This machine will not shut down tomorrow. It cannot. But once you understand how it works, you stop being confused by its effects. And confusion is the real cost most people pay. Because the quiet machine doesn't ask for permission. It just keeps running. Creating money. Creating debt. Creating winners and losers. All while most people are asleep.